the most important attribute that you look at is correlations. Correlations tend to be quite a bit lower when it comes to systematic strategies. Systematic strategies tend to be contrarian when they need to be, and also more persistent.
This show spans global markets and institutional investments through conversations with some of the world's leading investment, economic, and philanthropic minds. Welcome to the FEG Insight Bridge.
Today, we're diving into one of the most enduring ideas in markets, that the trend is your friend, and what it really takes to harness that insight into an institutional scale. I'm delighted to be joined by Leda Braga, founder and CEO of Systematica Investments, a global institutional hedge fund manager overseeing approximately $14 billion in assets. Since launching Systematica in 2015 as a spin-off from Blue Crest Capital, Leda has built one of the world's largest systematic investing firms. She holds a PhD in engineering from Imperial College London, where she also lectured and led research projects before moving into finance, a background that continues to shape her research-driven approach to market. Beyond her firm, Leda has served on the advisory board of the CERN Pension Fund, the London School of Economics Systematic Risk Center, the Standards Board for Alternative Investments, and currently serves on the New York Fed's Investor Advisory Committee. In today's conversation, we'll explore what systematic investing really means, what drives markets trends and reversals, the behavioral underpinnings of price dynamics, and how systematic macro differs from discretionary. We'll also discuss the roles systematic strategies can play in a diversified portfolio, especially during periods when they zig while others zag. What drove performance in 2025, and where Leda sees opportunities across commodity, currencies, and beyond in 2026. We close with Leda's thoughts about getting more women into investing and especially leadership roles. Leda, welcome to the FEG Insight Bridge.
Thank you very much. It's a pleasure and an honor to be here.
Well, thank you so much for your time. Hey, would you mind just very quickly introducing yourself and Systematica?
Yeah, so Systematica is an alternative manager, investment manager. We have a global presence. We have offices in several locations, including the US. We have about $14 billion under management in hedge fund assets, and we run a variety of styles, but mostly with the quantitative approach. So we are a systematic manager, and I act as a CEO of Systematica.
All right, so let's start from the beginning. Now, when you went to school, if I get this right, you were not in finance, but you studied as an engineer. So how did you make the jump into finance?
Interest in markets was something that came much later. My affection and my interest was with numbers and mathematics and modeling and problem solving. And then, in fact, I after I did my PhD, I had a short stretch as a university lecturer, supervising PhD students, teaching. But at the end of the day, you know, the discipline of engineering, the essence of engineering, is using mathematical methods, physics, using the technology and the technical-oriented tools to solve whatever the problems are which people have, right? And so I found myself in London in the early 90s, and the problem around us was finance. It was that was the place to go. It was there was a whole wave of hiring mathematically trained people into finance to do derivatives modeling, to price yield curves, to price more complex products, and I caught that wave. So that's how I ended up in finance. But it wasn't a given at all. You know, I love cars and motorcycles, and you know, so I'm an engineer. My husband builds model helicopters. We have two 3D printers at home. So
what was your engineering focus then? Not just and maybe for fun. What were you lecturing on?
Yeah, so when you're a new joiner in a big department, and then you're, you know, at the beginning of your career, you get all the fundamental courses, right? So I was teaching a lot of fluid mechanics and mathematics and all the the basic, which are somewhat difficult to teach, because if you think about it, right, you get all the young kids, like as they progress through their course, they gain in confidence. They start not to have quite so much to prove against you. But when they first join university, they are much rowdier and more difficult. And so it was quite a stressful time to control 100 kids in a lecture theater when the age gap wasn't that different. How old was I when I started lecturing? I was 26. So I went to university quite young. So, there wasn't that much of an age gap between me and them. So I taught whatever, I was assigned, basically, but all the engineering related disciplines. What was my degree on? I was mechanical engineering, always very focused on the math side. So finite elements, finite differences, mathematical modeling of various things. And then I did a PhD in that area as well.
Fluid mechanics with Leda Braga. Well, just imagine that. Imagine that lecture. So you go into finance, and maybe we should do some. I don't know, just kind of foundational. Make sure everybody, all the listeners, understand terms, right?
Mm-hmm.
So, what is in your mind systematic investing?
Yeah, that's a fair point. So if you think about the discipline of investment management in general, what does that discipline entail? Well, it's a branch of data science, isn't it? Because any investment manager is looking at the data and trying to make good investment decisions based on the data, given a certain set of constraints, right? So the owner of the money wants you to not lose more than that, or target a certain level of return per year, or not invest in certain geographies. So there are constraints. But the basic problem is I look at data and I try to make good investment decisions. At the top level, the systematic approach and the non-systematic or discretionary approach, they are the same. We're all looking at the data, trying to make good investment decisions. The systematic crowd tries to do that in a very process-driven way. So we code up our decision-making process. And that is the difference. That is the only difference. Of course, there are some other reasons that create some differences. For example, if you're going to trade very illiquid instruments or very illiquid securities, which require a lot of manual intervention for the mechanics of trading, it's more difficult to do that in a systematic way. But the essence of systematic is to articulate the investment process explicitly. That part of our job is to articulate the investment process. The discretionary guy wants to put on a trade that makes money. I sometimes say the discretionary trader is busy finding a trade that makes money. We, the systematic traders, we want to find a machine that finds trades that make money.
I feel like it takes away a little bit of that judgment element, that gut feel. It's much more truly, clinical and systematic.
That's right. So you force yourself. It's very process driven, right? You can see that it lends itself to the investor that has a lot of longevity in mind. So the investor that has liabilities that are in the decades, in the tens of years, perhaps that investor appreciates the fact that the key man dependency in what we do is much lower, because the intellectual property gets coded up, gets articulated externally to the people running the investment. But you are right. It is this need to be a bit more strict and think about all the exceptions that will happen, scenario analysis, and try to incorporate all the considerations that perhaps the discretionary trader can think as he goes along. Oh my goodness, 2008 came along. Let me take risk off. Well, we've got to think about these scenarios as part of the design of the process.
Well, let's continue to define some of the jargon that is in this industry. This area is sometimes known as, quant, of course, but CTA, trend following, systematic macro. What are some of the nuances here? I know it's not just exactly what you do, but in its essence, is it just trend following?
Yeah, no. I think it's historical, really. If you think about trying to articulate, you think about the old days, right? A bunch of people would call themselves traders. They would run books. They would buy things and sell things. They would construct portfolios in the hope of delivering a certain level of returns, given a certain tolerance for drawdowns. So that was the beginning. Then technology started to look at that problem, and back in the day, what was the immediate thing that you could do? Well, the first variable that you would look at, if you've got nothing else, is price, right? The price of the security. That is the fundamental first variable that you're going to look at. And of course, futures prices were much more widely available than any other form of pricing, because those were exchange traded, exchanges compiled and sold access to the data. So the first sort of quant or systematic approach to trading focused a lot on futures. And so it's historical, and that's the CTA side, commodity trading advisors. They're also known as managed futures traders or managed futures programs. So that is a sort of a big foundation of the quant approach is managed futures in CTAs, but it's just one piece. And then, of course, we've come a long way. Electronic trading is available for most things that we trade. Data is available, can be scraped. If it's not available, you can make it available. Banks, even for OTC markets, banks will let you connect to their interfaces and collect streaming prices. So nowadays, the range is very, very broad. Just about data for everything you can dig up with effort, and the trading mechanics of just about every asset class is accessible electronically as well. So I think these are all branches of systematic trading. So CTA or managed futures is one big piece. Quant equity is another big piece. So quant equity meaning, the amount of data around that can be used to gain an advantage when betting on equities is phenomenal, right? It's the news, it's quarterly announcements, it's sentiment, it's geopolitical news. So the amount of news that can be used to build an equity trading program is very, very broad. And so quant equity is, again, a very popular style for the quant side of things, because we can deal with that amount of it. A human being would have trouble keeping track of all of the data that is available to bet on a particular set of stocks, right? So that is a very good job for a machine and for an algorithm. So quant equity, CTAs, managed futures. What else is there that people talk about? Let's think. There's quite a few flavors there, right? So you find that there are people that specialize in vol trading. There's then a whole class of people that look at the most common hedge fund styles. Most common hedge fund styles over the years have become this, and this. Well, let me systematize just these themes, and that's referred to as alternative risk premium. That's another. But all of these styles have in common the fact that they are typically implemented through a set of rules and an algorithm.
Yeah, I like that. No, it's process, and then to your point, it's breadth, right? Because I always find that most systematic firms, just the number of trade securities is much greater than someone who's trading discretionary. To your point, you can't keep track of all of these things, but a machine can.
Yeah, that's right. So the discretionary trader will typically have much fewer positions, much fewer trade ideas, and will only put a trade on when the confidence is super high. We, the systematic guys, rely much more on a diversified set of bets, which on average delivers the correct outcome.
No, I think that's also a kind of an important piece too, right? Is the level of conviction is right.
Yeah,
You're placing many bets, right? And you systematically believe a certain percentage of them is going to pay off. Where if you're a discretionary, you're betting against the I don't know, the euro or the Thai baht or something like that, right? You're going to have a lot more conviction in that trade.
exactly,
So it's
exactly.
just different. Now, you're not the only group to do this. There are many groups out there. How would you differentiate yourself from your peers?
That's a question that we often get asked. There are many angles to that. I think when you compare different quant shops, one of the important variables is size. How big is that? So I think we are in the kind of 10 to 20 billion level. That's one size. Shops that become 100 plus billion, they become a bit different, right? The sales machine is very, very large. The concerns about capacity and whether you impact the market or not when you trade become a bit more important. So I think size is an important one. I sort of feel that we are at a very good size to interact with institutions, because we're kind of big enough that we can accommodate the tickets and fund the research that we need. And at the same time, we're not so big that we don't know our clients. We know our clients really well, and we understand why they invested with us, why they chose the products they chose. So I think size is one. Then, of course, the culture, right? Different people will have different ways of doing things. I think the culture has a big impact on the ability of the team to be creative. We try very hard here to be a very flat organization, to listen to opinions regardless of whether they come from a very experienced person or from a relative newcomer. I always tell the guys, look, you can't offend any of us. Ask whatever you want to ask. There's no such thing as offending us. So we try to foster the intellectual debate. We try to address conflict very promptly, and it takes managerial effort to do that, right? It's not unheard of that managers will just let problems brew. We try not to do that here, because we think if there's a lot of tension in the team, then people don't innovate, don't create anything new. Their ability to propose new things and to try them gets curtailed. So I'd say the size, I would say the culture, and I would say also perhaps the geographical presence. We are very firmly a global firm. We employ 140, 150 people, and something like 30 nationalities within that team. And so it's really amazing. It's a very diverse team. It's people from all backgrounds. So that is another interesting cultural element.
All right. So going back to kind of maybe a quant answer for this, what is the role of a systematic manager in a client's portfolio? What's the benefits other than maybe just return that you provide?
Look, I think the benefit is that because we're so process driven, I would argue that if you are an institution building a portfolio and making an allocation, you should really reflect on the role that allocation plays in your portfolio. And possibly the most important attribute that you look at is correlations. What risk contribution is that strategy making within my portfolio? Correlations tend to be quite a bit lower when it comes to systematic strategies. Systematic strategies tend to be contrarian when they need to be, right? And also more persistent. We've got lots of charts to show people who are interested. In fact, we've just published a little paper recently TPA, the total portfolio approach. And one of the comments was this: look at the level of correlation across hedge fund styles, and look at the hedge fund styles that are deemed systematic. Now check out, 5-year windows, 10-year windows, the correlations between that style and the other styles is invariably lower, no matter what period you look at. So I think the systematic strategy plays a part in that if you are constructing your portfolio, you want to be able to pick things that are going to behave consistently in that way, right? So another anecdote for you. So as you know, Systematica is a spin-off from Bluecrest, and Bluecrest Capital grew to be a very large firm. I had the privilege of acting as president of that firm. We had about half the assets on the discretionary side, half the assets on the systematic side. And the firm grew to be at $35 or $37 billion at the peak. So it was a large firm. So 2008 comes along, and the discretionary side, the discretionary funds that we ran there, they didn't do badly. They ended the year up, small. The systematic funds had a tremendous year. They did incredibly well. Now, I remember going for a coffee in the kitchen of the firm and having a conversation with my colleagues, the senior traders on the discretionary side. They thought the world was going to end. They were so negative, but they weren't short. They took risk off, and they weren't necessarily high conviction short. Whereas the systematic side said, okay, this is the signal. Can we run these positions? Yeah. Are they within risk limit? Yeah. Are we executing correctly? Yeah. Well, so we run it. When you articulate your investment process that explicitly with your client, you feel you have the mandate, right? We debated this at the time. Goodness me, are we supposed to take risk off? Everybody's taking risk off. And I remember having these meetings with the guys. Come on, guys, if investors sitting there at the table with us, why are we going to be cutting risk? Can you tell me why? Oh, because vol is very high. Well, our models account for the levels of vol. So that's not a good excuse. Oh, execution cost is very high. Okay, so again, our models account for that. So that's not a good excuse. Oh, I'm concerned about counterparty risk. Okay, let's evaluate that. In fact, we did at the time change some of the counterparties that we traded. We mitigated the risk. There was action to be taken there. But in general, you sort of felt that I've got a contract, I've got a mandate to run this risk. I'm supposed to run it. And when you do that, then you can deliver outsized returns when people just kind of shy away, right? So I think that is the game, really. There are some other aspects that I could talk about. For example, the scale, right? The fact that as systematic, we run some investments. We've got a pricing scheme that honors scale, right? So large investors pay a bit less than smaller investors, and that is perfectly possible if you run a systematic shop, and that is in the interest of the large institutions. But I think that the core point is this ability to trust the correlation properties of the strategy that you go into, and to trust that the process will continue, and you're empowering these investment managers to follow that process that you signed up for. That's very powerful.
Yeah, that definitely the correlation benefit is amazing. And maybe to give to listeners some sense of that, I think most people have the majority of their portfolios invested in equities and then, bonds, right? What are some of the more esoteric instruments that you might invest in, just to give them an idea of the kind of the breadth and diversification that you provide?
Yeah, so we run about 6 major strategies across the firm. Some of them focus on what the so-called alternative markets. So it's just markets that are difficult to access. But some of them trade vanilla markets, some of them trade equities. So we've got a number of flavors here. The program that runs the alternative markets runs about 400 different markets. I mean, it's amazing that it's such a large group of markets, none of them trivial to trade. But things like emissions, California emissions, or electricity contracts, or German electricity, or Chinese commodities, the bottle flakes and jujube and and also some emerging market currencies that are non-deliverable, difficult to trade as well. On a perhaps less exotic side, but still difficult to trade, interest rate swaps of various maturities that we trade as well, some credit products. But in terms of glamour, what people like to talk about is the alternative commodities, right? The alternative commodities, steel rebar and peachy acid, and so these things are quite interesting.
I always laugh. I was like Rotterdam coal. It's like some of these things are just like really esoteric, but investors are not getting exposure to that in other parts of their portfolio, right? So not only the way you trade, but what you trade can provide a lot of diversification.
And then these markets are interesting because the kind of big vanilla markets, they're filled with market tourists, right? So everybody trades the S&P 500. So there's some piece of news, everybody reacts to it. If you are, as you say, the Richard Bay Cole trader, what do you care? You're trading your own discipline and you're more focused on the underlying. So the idiosyncratic effects have a better chance of manifesting themselves.
So you mentioned that you can be a little bit contrarian at times, where because you invest in all of these kind of unique things and common things as well, right? But you do it in a process that may be a little different or out of the consensus. You can zig when other things zag, and I guess part of that is you can attribute to, well, that's what you want. That is diversification at its best. However, the kind of the behavioral side of humans always want to point out what's not working. So is it hard to, and maybe this is a good question for your IR people, like how do they keep investors invested when things can go wrong for quite a while and maybe not be as obvious? There's no story behind it.
It really is. It really is the challenge. So 2025 is the perfect example. 2025 was a difficult year for several of the styles that we run. We run 3 big trend following funds. All of those funds had a tough time in 2025. They had a fantastic recovery from just about the midpoint of the year, like, a sharp ratio of 3 and upwards between that midpoint of the year and now. And they've been having a very good start to 2026 as well. So you are absolutely right. Sticking to the investment is tough. What can we say? Our investors over the years have become more and more technical. And that's a blessing, really, because you realize they understand why they're investing. And the biggest investors that we have, you would be surprised, right? So we go through this terrible drawdown in 2025. Some of our big investors don't even call. They don't even call. We are the ones saying, well, would you like a briefing? Shall we show you that, things are controlled and transaction cost is within Yeah, well, we might top up. You say, okay. So there is that which didn't exist perhaps 20 years ago. Huh? So 20 years ago, the institutions were just touching on hedge funds. They've become very technical. And then, we do what we can to educate and to help. We are all personally invested in the funds that we run. So investors derive some confidence from that too. And I often say, right, I say to the colleagues here and to people in the industry that, when it comes to investment management, the man in the street, what does the man in the street see? He just sees the prices and the returns. We are the professionals in this industry. We need to do better than that. We need to build our confidence based on something other than last month's return and today's price. And if you can't do that, then you're not really adding value, right? But in general, we benefited from great support from 2025 was a test. Deep drawdown, the whole U.S. administration style of news and policy decisions didn't help. A lot of short-term volatility. big reversals. Of course, when the market teaches you, right? So new data series, we're always learning from them. So there's some amount of prudent model adaptation that takes place. So you become a bit better at dealing with whatever the market throws at you. But 2025 was not pretty, and the assets were very sticky. Investors were very supportive. We communicate. We tell them, we show them, we share all the tire kicking that we're doing, and of course, it's not that we enjoy it, right? It's a poor experience for everyone, but redeeming at the bottom is only going to make things worse.
Well, a couple follow-on questions to that. I mean, I is an environment like this where there's just it feels like one headline after another. Is that a tougher environment for these strategies? I know it's not all that you do, but a big part of systematic investing is trend, right? It's kind of foundational. It was the beginning. And if you have a lot of whipsaw and reversals, exogenous shocks, whether it's a tariff announcement or perhaps people worried about Iran or some other Russia, whatever. Is this a really tough environment for systematic investing, and how do you deal with it?
Yeah, that's fair. I feel a little bit vindicated because as we went into 2025, many investors would ask that question. Oh gosh, the regime has changed. Things don't work like they used to anymore. What's going to happen? What's going to happen? And through that time, I've said something that I think came to pass. I kept saying to investors, look, it is a new style, and the US is a very important and relevant economy globally. And there is a new style of handling the news and making policy announcements and making decisions. In the beginning, models will stumble as markets themselves stumble to deal with these news. But if that style persists, eventually markets will ignore it and they will decide where they want to go based on the whole picture. And they will just do what they want to do. And by the way, trends will form because this is a shift. It's a macroeconomic shift in the way the world operates. And I think it's fair to say that has happened. If you think about it, my God, nowadays there's these big announcements, tariff threats, or markets don't even flinch. And you think, wow, but they've got a view. Their view is there's AI, there's potential deregulation, and so equities are going up. And so they have a view on the dollar. Well, okay, this economic the style of this administration is going to have a certain effect on the dollar. So that is our view. And so I kind of feel that is what happened, right? So in the early days, even markets don't know, oh, goodness me, better cut position. Oh no, better go back in. Oh my God, high volatilities everywhere. Eventually, excuse me, a lot of noise. What is the underlying picture? The underlying picture is interest rates are going to do this, the dollar is going to do this, equities are going to do that. And so then markets have a way of, establishing some average committed opinion, right? It's not a free opinion. The market opinion is an opinion that you pay for through your trading. So it's a committed, priced up opinion, and it deals with noise pretty well.
I agree. It seems like the market has learned to ignore some of the noise and rhetoric.
Right?
And
amazing.
It really is amazing.
I mean, you look the other day, so then they announced a massive spend in AI and the market sells off. So markets are just doing what they think they should do, and they're interpreting the news in a big picture way, right? It's remarkable. It's a very powerful thought machine, the market.
Wisdom of crowds. So maybe you can help me out here, because this is I've always struggled with this. So when you're underwriting a more fundamental manager, could be a hedge fund manager, could just be a traditional manager. When they go through a period of underperformance, it's easier to underwrite. Maybe they lost their number 2 trader and really he was the top performer, or maybe the research was wrong, but you know what their research was. They had a fundamental view, it didn't work out, or maybe it's a merger arb deal and they assigned a certain probability to it and it broke, but it was still within that range of probability. Boy, it is so hard to underwrite systematic managers when they inevitably have those periods of underperformance. What would you say to an allocator or someone doing due diligence after a period of time, maybe like the one you just came through, to be like, how should someone come in and make sure that the system isn't broken?
Look, the same process that you described that people go through with the discretionary manager can be run with the systematic manager. The difference is that the discretionary guy has a much more limited number of trade ideas and positions, so he can have a quick conversation with you and explain how his big ideas didn't work out. For us, this is a more of a statistical presentation where we kind of show, and we've shown investors this in 2025. Look, it's the signal. The signal is faltering. Look at these statistics. Look at the error rate or the conviction rate, and look how it's behaving. It is the signal. And so what we can't do is have a 400 little conversations about each one of the 400 alternative markets that program runs, for instance, and explain for each one but we can do a few to show, look, this was the signal. This is how the signal was clocking up. Why was it clocking up that level? Well, because look at the price action. So it is not a wrong calculation. It's just the ability of that signal to forecast correctly is a bit challenged. So I would argue that the same principle applies, where you investigate the reasons why the model is not working. It takes a bit of patience because it'll entail some mathematical explanation and some charting, but the principle is the same. I would say, in addition, that there are some advantages that you can't really apply to the discretionary trader, and I know that from experience. When you cut risk from a discretionary trader, that distorts his ability to trade, right? And so the recovery of the discretionary trader is never objective, right? You tell the guy that he's hit a stop and you're going to cut his risk in half. The book gets instantly distorted. And when he starts to make money back again, the way up is distorted. That is not the case for the systematic side, right? So one of the things that you can do as a systematic trader, you have all your modules, trading modules that make up a fund. Typically that's what you have, right? You don't have a single model for a fund. You have a collection of strategies. You can actually temporarily deallocate from a strategy if you feel that, gosh, the forecasting power seems to be a bit on the low side. Let's turn the risk down for a while. I can tell you with 100% certainty that I can observe that thing continuing to trade exactly like it did before. And when it recovers, I can tell you it's recovering because it's recovering. It didn't get lucky, it's just running its process, which is something that the discretionary trader much, much harder to do. So another point to make as well, which I discuss often with investors, is you kind of hope human beings learn from their mistakes, right? It's a hope. Algorithms definitely learn because we make them learn, right? We sit there and we say, okay, what went wrong? Let's understand it. Let's evaluate the constraints. Let's look at the edge cases. Let's understand, and let's incorporate that into the algorithm. So I don't know about human beings, but algorithms definitely learn because we make them learn. So I think on balance, I think really the big difference is that human beings like the warmth of a human conversation. We all do, right? This is why people have friends and they do therapy and all the rest of it. And so it's much easier to have a conversation with a trader and get that reinforcement that that trader is still a very smart person, is still very committed, is trying really hard, and has explained to you what's going on. That's much easier than sitting with us and looking at charts and probabilities and rates. It's a much drier conversation. It's the way of the world, right? Naively, I'll tell you one that makes me laugh every time I think about it. I remember when the phrase data-driven decision-making came about. I had never heard that phrase before, data-driven decision-making. I remember the first time I heard this, I said, data-driven decision, is there any other kind? And then, within a second, I thought, Leda, what an idiot. Of course, there is only the other kind. Decision-making, on average, is emotional. We make emotional decisions all the time. That is how we decide our lives. And this is probably why we get into so much trouble. But so I think decision-making, data-driven decision-making is harder, it's colder, it's more objective, and it doesn't satisfy the human need for connection, for warmth, for, and that is the difficulty of systematic trading. It's not that it's a lack of competence or a lack of competitive edge. It's because we're all human beings, but that's getting better. That's getting a lot better, I think.
So basically, and I like that, stats versus stories, and that's how you evaluate a systematic manager. So we talked about 2025 being difficult, and to be fair, you pointed this out. I mean, boy, what an incredible close to the year, big rally. As we're in 2026. What's going on right now? What are some of the markets that you're excited about in terms of seeing them kind of move and seeing the numbers right? Again, we're talking numbers, we're talking math, we're not talking fundamental stories. But what's moving? Is it precious metals? Is it commodities? What's driving performance?
There's some big macroeconomic themes. If you ask about the funds of our firm, to be precise, I would have to describe different styles that are all very different, right? So, for example, equity market neutral banks on idiosyncratic differences between companies, and so that's a completely different department. But when people talk about the macroeconomic themes, it's the big macro programs that they're thinking of. So the sort of mainstream trend follower that we run, for example, which is up a stack, is had a phenomenal January and is having a very good February again. So what are the themes there? Well, it's been funny. The programs have made a lot of money on stocks, but global stocks, it hasn't been a single trade, and some of the positions were actually temporarily short in certain stocks. And so, stocks have been a big source of profit. Commodities have been a massive source of profit as well. Of course, the precious metals are the top of the list. Let me try to think what else. The dollar, the moves in the dollar versus other currencies, those moves have been very, very sharp. So in terms of sector contribution, and the key player has been the equities, but from memory, in January at least, all of the sectors were up. And then in February, commodities, we reduced the risk a bit, and commodities were sort of flattish, but all the other sectors were contributing positively as well. So it's big macroeconomic themes, right? It's a challenge to the dollar. It's trends in interest rates. It's precious metals receiving a lot of interest. So those things are driving the gains there.
Well, that's great. Hey, you mentioned it earlier, but AI. How does AI change the way you do research?
So that is fascinating, actually. So we've had early February we have a planning session for the year ahead within the firm, and so it's a 2-hour planning session, and we go to a venue. Everybody puts a bit of effort into their presentations, and it was amazing to see how much is going on in the firm with respect to these new technologies, all the way from productivity gains. So the more, say, mundane things like, the legal team uses AI to deal with documents, to accelerate reading and production. The client services area uses AI to improve their ability to report as well. and then on the research side, there's at least a couple of dimensions. One, making data usable. So your ability to process large amounts of unformatted text to extract data from it, that really goes up. And that's one avenue. And the other interesting avenue is alpha making itself. It's amazing what the guys are doing here. All the way from creating alphas based on a thesis, like give an agent an investment thesis, throw a bunch of data at that agent, and that agent can construct alphas for you. All the way from that to actually getting the agents to read papers and read books and implement the thesis of those books and papers. So I think we're going to get a lot faster at monetizing information for investment management. I think it's a really powerful period ahead, really. But super interesting stuff, super interesting. And it's made possible because we've got the infrastructure for exposing data items, for computer power to process hundreds of thousands of alpha constructs, on the cloud. So in a way, right, the IP is almost just before you actually call your agent, is the fact that your agent needs to have access. So for example, we've got a domain specific language, a language to build alphas with. And so the agent can use that, and it's much easier to construct an alpha when you've got that. So all of those things are the IP of the firm. But really, really interesting, super interesting. There was a buzz at the end of the February meeting, I have to say.
Well, I think that's fascinating because, and to your point, perhaps systematic firms, quant firms, are best positioned because they have to have their data is really tight, right? They have to have data integrity, and so to have AI on top of it, that's pretty good. Where a lot of people may not have their data in a place clean enough to actually be able to trade on.
In scale as well. Scale, the fact that we always worry about scale means that we have been building our systems for a few years now based on the cloud. And so for example, for the equity program, we have hundreds of thousands of alphas that get computed. Well, if you try to do that in your own little data center, that's going to be problematic. It's not cheap to use AWS, I'll tell you that for nothing, but at least you can scale it up, right? You can run it. And if you're doing things manually, then you cannot. Equally, the ability to measure all of your trading in an objective way, to evaluate transaction cost, record everything, the price at the time the decision to trade is made, the price you executed at, the average price, the comparison, all of the parent orders, the child orders. So storing all that for analysis, again, is very powerful. And the discretionary trader perhaps didn't have the need to do that. So.
All right, Leda. So you're one of the very few women that are running a hedge fund. As a dad of a daughter who is studying finance, how do we get more women into hedge funds and into leadership roles at hedge funds?
Our realization here was that no matter how much we desired to hire women and increase our presence in that particular minority, they just didn't come to interview, right? So it's like, oh my God, you can't just appoint them out of thin air. They don't even turn up to interview. So our reflection many years ago was that our efforts needed to be upstream from the hiring point. So we need to get more women interested in careers in finance and careers in mathematics. So there's a couple of initiatives that we're part of. One, which is very interesting, is this initiative called Math for Girls. And Math for Girls is all about promoting awareness at school level of the possibilities that open up for you if you give mathematics some emphasis in your studies, doesn't have to be the be all and end all, but if you keep your mathematical skills current. And so we are very involved with this charity. We sponsor quite a bit of the activity. The whole idea is to promote touch points between women in finance and schoolgirls. And so there's a technology platform, a great big database of schools. Schools sign up for the program. Then speakers sign up on the other side, and those speakers get a bit of training, what to say, what not to say, how to behave. And then school visits get organized where these speakers go to the schools and talk about their careers and talk about mathematics and talk about the possibilities that it opens. And it's been a phenomenal program. I think, we are on track. We've surpassed 1 million encounters by now. The objective is to touch all of the school system with that. The feedback is incredible. Like, the difference that it makes to these girls and to these young school children to have a nice looking, charming professional walk in and talk about, look, this is what I do for a living. And, you want to pay attention to these skills. So it makes a lasting impression in these young kids. And many of them of course, the charity focused in the first instance on schools in underprivileged areas. And so we realized that with a lot of these girls, you're talking about girls whose parents, for all the love in the world they may give their children, they just don't have access to that horizon of career possibility. And so if you can't really see it, how can you even dream it, right? So it's super exciting to be able to promote those encounters and to open up their minds, and so that is one thing that we do.
Very cool. Very cool. Hey, before we recorded this, we were kind of joking around a little bit. I loved your comment. You're like, there are some benefits in being one of the few women in hedge funds. Yeah. Would you share that? I thought that was hilarious.
I know. It's so that there are very few, right, senior women in our industry. So that means that people like me get a lot of extra airtime for no apparent reason, So.
For good reason, but also yeah.
I don't know about that, but no. So I get a lot of support and a lot of attention. I feel, me personally, I don't know, right? I was brought up, with brothers, and I cannot say honestly that I have felt a lot of prejudice and a lot of extra difficulty in my professional life. But then again, I've got close friends that say to me that it was all there. It's just that I chose to ignore it. But ignoring it is not a bad way to go about it, isn't it? And if you've got to kind of fight the war and move on, if you've got to do something, you've got to do something. I will say one thing, right? This industry, the financial investment management, is a very, very numbers-oriented industry, right? So if you're going to measure success in this industry, success can be measured, and it's basically evaluated by numbers. So if you are looking for the hedge or the protection of your performance being evaluated for what it is and nothing else, this industry is very good for that, isn't it? So that ought to encourage minorities that feel that they have to fight a bias to come into our industry.
That's great. No, that is. Thank you for sharing that. And I don't know, I was just laughing because in the beginning we were talking and you were like, I often get to sit at the head of the tables for a lot of these fancy industry dinners.
That's not next to the most amazing personalities, because you turn up for a dinner of 12 or 20 and I'm the only woman. So invariably I'm sitting to the right of the guest of honor. So I'm not going to complain, am I? Just make sure I wear a nice suit when I go out.
That's great. So, all right, what is outside of investing? Is there do you have any hobbies that are You said you like motorcycles and building things. What kind of crazy hobbies do you do?
Yeah, I do. I like to work, right? So work takes a very big part of my life, I've always liked to be productive and to work. So this is a little bit of a hobby, I have to say. But I like to exercise. I really do. So I all forms of exercise. I used to love scuba diving. Haven't been doing much lately. My husband has had a lot of sinus problems recently, so we haven't been able to go, but I love diving and I've done a fair amount of diving. Also like rock climbing. Rock climbing is a great sport, right? It's a bit mathematical, isn't it? You kind of plotting a path through a rock, and so it's a nice activity. But in general, I like to exercise. I like the outdoors. But I have to be frank that work is a bit of a hobby, isn't it? Because
probably all consuming, but it's good to have some activities for stress relief. So, what is a fun fact that nobody knows about you?
Oh my God. What is a fun fact? Well, I'll tell you one that it became very important to me because I'm a big fan of his and he passed away. Have you ever heard of Daniel Kahneman? So yeah. So
Thinking fast and slow.
Exactly. So I was once there were two keynote speeches in this conference I attended, and he was the keynote before me, and I was right after him. And unfortunately, he passed away. I've got the most respect for his work and for what he says, and in a way, the whole framework of decision-making analysis that Kahneman has offered lends itself a lot to understanding the power of systematic trading. Right? He talks about decision-making, right? How do you make it, and how healthy it is to try to eliminate emotion from it if you can. And so, I remember there was this keynote, and he gave his keynote, and in his keynote, he actually said, look, I don't know much about investment management, but my suggestion is you should make your decisions with good due diligence, then walk away from them and let them be. So when I went in after him, I said, I promise I didn't pay him to say that. So there you go. So I've got a photograph of me with Daniel Kahneman on my in my front room. I'm a big fan. So there you go.
Oh, that's great. That's great. Well, Leda, thank you so much for all your time today. This has been marvelous.
Oh, it's my pleasure. It's my pleasure. Thank you for having me.
If you are interested in more information on FEG, check out our website at www.feg.com. And don't forget to subscribe to our communications so you don't miss the next episode. Please keep in mind that this information is intended to be general education that needs to be framed within the unique risk and return objectives of each client. Therefore, nobody should consider these to be FEG recommendations. This podcast was prepared by FEG. Neither the information nor any opinion expressed in this podcast constitutes an offer or an invitation to make an offer to buy or sell any securities. The views and opinions expressed by guest speakers are solely their own and do not necessarily represent the views or opinions of their firm or of FEG.